All right. Well, again, thank you guys for coming to hang out today. This is the second part of our Business by Design and Abundance course for business owners and also for individuals, helping you understand what IULs are. Last week, we kind of went through how it benefits the business owner to utilize executive bonuses for their businesses. What the code is, and how you can actually utilize the insurance to bonus out yourself, your employees, looking at what key employees are, those people that are important in your business that allow you to continue to grow your business if something happens, but also give your employees incentives. Nowadays, it needs to be more incentives for the opportunity for employers to help the employees build their retirement plan and what that looks like. So this week, like I said, we'll go through kind of what the three secrets are, which is really not a secret, but it's just the three main advantages, disadvantages for having a max funded IUL. And then we'll go from there. Let's put this up here, start from the beginning. And I'm gonna have to skip through some of these. All right, like I stated, the three secrets to a max funded IUL. We should have put a picture there. First secret, just worry about that, is eliminate taxes and losses. That's one of the main advantages or the dangers that an IUL prevents. Next question will be will future tax rates be like? Will it be lower, the same, or will it be higher?
When you guys in the room, what do you guys think the future taxes is going to be?
Probably higher, especially yeah.
I mean, again, you guys are correct. As we know, inflation is going up. And that's one of the things with IULs, and when my gentleman here was saying about he wanted to roll out his 401k is right now being taxed at the lower rate. Right now, you can't get any better rate for your rollouts or for your taxes that will be taken out of those policies or the 401ks right now, because again, inflation will go up and taxes will go up. We talk about compounding interest. $1 doubling 20 times. What does that look like? As it compounds, again, the $2 doubles 20 times is $1 million, $1,448,000.
We're all adults in here. We do understand compounding interest and the power of it. Right? I got asked last week.
No, most definitely. Also, the next thing will be the 25% tax bracket. That's where mostly everybody's placed at right now. $1.75 goes to $3.60, all the way down to the amount that it will double 20 times is $72,570. Now, at a higher tax bracket at 30%, look at the difference of the taxation that's being done. So within that, the million, this compound, that's tax free. You're being taxed on the front end, that's $72,000. With the 33%, that's being taxed on the back end. You only, from that $1.67, you only get $27,000 after taxation. If you were a farmer and had the choice to pay taxes on the seed or the harvest, which one would you prefer? On the seed, correct.
And that's the power of even drawing, like right now with where the current market is. If you were to draw out that 401k, you're going to be paying interest on the seed. If you were to leave it long term and draw it out towards the end, you're actually going to be paying interest on the harvest. So just think of a seed and then think of a lot of roots with the whole apple tree with crop on it. So you're either going to pay taxes on the seed, or you're going to have to pay taxes on the entire apple tree and the inventory on it as well.
No, perfect. That's a perfect analogy. Sometimes what they've done with the 401ks and these IRAs is they tell you to tax defer. You wait till tax defer. You wait till the time for you to pull out that money, and you're being taxed in the beginning on pre-tax money, and then once it's time for that later on in life, because then they make you take that money out at a specific rate. And right now, a lot of people are only able to draw on 4%. The 4% rule is which they only allow you 4% deduction in your 401k. Again, eliminate taxes and losses. Everything good, fella? One of the rules, and this is probably something that everybody should remember, is that Warren Buffett has 2 rules of investing. Number 1 is don't lose money. The second one is don't forget rule number 1, right? So again, it's really paying attention, creating your next step by allowing yourself to have all the options available to you. A myth: Wall Street average rate of return. First year, plus 50%. Second year, 50% loss. Again, third year, 50% return. Then another loss. And then within that 4-year average, you really don't balance it back out within those losses of the 401ks or that which is placed in the market. You have to have over at least 120% return in order for you to even gain your money back from what you lost. So that's the market risk of allowing the 401ks or even playing in such a volatile market, that with an IUL, we provide those guarantees of being able that you can keep your upside gains and you never go below zero. Zero is the hero in our product.
So for people that say, well, I have a 401k, I had it back in 2008 when the market crashed and, the market regained its momentum. Well, it never regained at 110%, and the market never regains at 100% or 120%. That would be the only way that you're going to get back what you've lost. So the market may recover, but you never recover the full amount of what you lost. So there's always going to be a risky market. So even with the Roth IRAs, the bill passed, Biden passed the bill that they're even going to start higher taxations on Roth IRAs, which is even crazier because now we're talking about more loss for our people. And then this is why, one of the biggest reasons why we bring this awareness to people, because a lot of people just don't follow the news in those areas. It's not a concern. You have a 401k, you assume that you're okay. I'm going to lose a little bit, but you're actually going to lose a lot.
Most definitely that. So actual performance. We just went over what those 4-year performances looks like. So you start at 100,000, good. I mean, the first year is looking well. Then the second year at 75, that's a 50% loss in that 150,000. Then actually in that up year, going back, you may get back to 112,000 with a plus. But then again, if we go back down, that's a minus 43% loss that you can never get back. That's just money lost and with the IUL. Again, there's a zero floor, but this is just what the S&P 500 of what it will actually look like in the market with losses. Avoid losses and generate predictable good growth through utilizing indexing. This is a 20-year graph of what the S&P 500 looks like. Where your money is at in your 401k. As you see, the years, the red years are the downplay, with the depression within those first 3 years of when the IUL started. Then we had 4 good possible years. I think this was in 2008, this part right here where the -4 and -40%. Then we went back up, stayed constant. And again, as you see, all the reds are the years of loss. With an IUL, you have all the upside gains and none of the downside risk.
Now, real quick, Nicholas, where it says around 2008, when the market was down over 40%.
Yes.
They're estimating this time around is going to be even greater than 2008. So just imagine where we were for those of us that were around in 2008 to see where the economy was back then. They're estimating that the market it'll have a greater significant loss this year than it did in 2008. And that's always going to be your marker.
Most definitely. Yeah, well, we'll go to the next one. The next secret is optimizing your gains. What you see here, as it states, the S&P 500 is the red. The IUL is the blue. And then what we call the laser fund, which allows you the liquidity, the asset protection, the safety, and the rate of return. For those that are able to maximize the product to its fullest capacity. The majority of the people that we may talk to now, you're not able to basically maximize it because, again, you're trying to allocate funds, you're trying to get an understanding of what an IUL is to be able to help you. So this is an opportunity to be able to grow that to the right direction.
And real quick, this laser fund is basically a max funded IUL. So you're max funding your index universal life policy. As you see, they both have an amazing amount of growth, but when you add just a little bit more into that IUL, you're going to get even more growth. So that's the difference between the IUL and the laser fund. Laser fund is just another word for max funded IUL.
It's more precise. And if you have money that you can roll over, money that you have to do lump sums into a policy, which will allow you the faster accumulation, faster growth of your policy, of the contract. Let me take that back. It's not a policy, it's a contract. So that you can actually have the income and the accelerated compound interest for the lifetime income you're looking for. Avoid losses in generating predictable utilization of the index. We just kind of went over that before. Again, just showing the growth, upside potential. You never lose because we have a zero floor with the product of an IUL. Again, showing just the difference of what an IUL and the S&P 500, the continual growth of what the IUL does compared to the laser, not going to say the laser fund, but the S&P 500.
Now that first year, let me go back to that one real quick. I wanted to point out something. So as you can see, like these first 3 years, for the first 2 years, we're balanced, right? And that's the power of an IUL. When he's talking about the zero floor, is you will never lose. So you may not gain, but you'll never lose. So that's why even when the market, when the S&P 500, of course, is showing that it's down and it's showing even right here, that's just what we call our zero floor. You'll never see an IUL drop below or lose because you have upside gains of the market and you have all the downside protection. So you're protected from any loss ever.
Yeah. Let's skip this. All right. Third part is maximizing your expenses. this is probably one of the best analogies that we could find, or even compare an IUL with when we're maximum funding it. And also, this is kind of the same concept of when you're doing the minimum opportunity within the IUL conversation. Think of it as this policy is a type of insurance policy that can be compared to owning an apartment building or running a business. If you were to own a 5-story building apartment, and the goal would be to rent out all 5 floors in order to maximize the profits and minimize expenses. If only the first floor was rented out and the remaining floors left vacant, costs would remain extremely high and eat away at your profits. That's the same concept that you think of as in max funded IUL. The max funded, the maximize your returns and minimize your expenses. Fill out your contract with the maximum planned premium that is likely to rent out all the available floors. This can be compared to accomplishing this within the first 5 years using the IRS guidelines that allow you to put in as much as you can, accelerate through the amount that you can put in, and then the distribution at the end. The answer to this is within these IRS codes. These are grandfathered in. These have been in the tax code for at least 100 years. And you know, we're not actually privy or quite understand that these tax codes are the purpose for why you can actually use these policies as we're speaking of. 101A is a tax-free the distribution, actually accumulation, sorry. Then the 72E allows the growth tax-free. And then the 7702, which will be the distribution phase, will allow you access tax-free.
Okay, real quick before you skip. So the power of the IUL is that you have the accumulation part, but you also have 90% of accelerated death benefit. We're talking about the access tax-free. We're talking about the accelerated death benefit part. So every IUL has an amount. So let's say it's a $500,000 IUL. You're gonna have the whole $500,000 is tax-free. It's cash accumulating tax-free. But in the event of critical, chronic, terminal illnesses, serious injuries, where you can't perform 2 out of the 6 main functions, daily functions, you can actually access your policy while you're still living. This is also what we call a living benefit. So the 7702 rule allows you to accelerate, have the acceleration death benefit given to you and access tax-free. So that $450,000 that you're pulling out of that $500,000 policy, you get approved for the whole $450,000, it's completely tax-free, thanks to the protection of the 7702 code. Questions on that before we jump? Because I saw that.
No, I'm really gonna kill it after this.
Yes.
All righty, so with those codes, which allows, let me go back to that one so we can actually have an understanding where we at. All right, so with this is the tax-free. 101A allows you the tax-free. And I would like for you guys to do a little studying before we get back to the next one. TEFRA. This is another governmental word. Do some homework and let you guys find out what that is to do your research, which allows you the tax-free within the tax. This is a government, these are government or terms that they actually use. TEFRA, DEFRA, and TAMRA are associated with the insurance companies, which allow you, which are connected to the tax-free. TEFRA and DEFRA allow you the tax-free accumulation. TAMRA gives you an opportunity for the tax-free distribution that's written into the tax code, which basically allows you the validity to not have that placed on your income tax, your 1040 forms. So that takes that actually takes that off of your passive. What are the three that allow you on the tax code? It's passive income, rental income, and distributions from your IRA and 401k. You have anything on that one?
No.
So this basically shows you how you become self-insured, allowed through the premium. As you see that the allowable self-insured premium for specific ages, 35, 55, and for 75. At 35, you have the most room at a minimum amount moving forward. At 55, that's part of the death benefit and the cash accumulation that you will be able to allow yourself to become. How much money you have to put in order for it to be self-funded and self-insured.
I like to explain these like purchasing a house. So term insurance, whole life insurance, IUL, right? Term insurance is like renting an apartment complex. You absolutely gain no equity in that apartment. When your term is up 20, 30 years, it's over. If anything happens to you, you have no equity in a term policy. A whole life policy, you actually now have equity. It's like buying a house, right? I'm gaining equity in my house. However, when something happens, I can only access the equity of what I've gotten. So what you're seeing here is the equity within the policy over the years. And then an IUL is the same like a whole life. So I'm a homeowner. I'm gaining equity in my home, in my policy, but I also have 90% access to this while I'm living. So this is the equity that's gaining. However, with an IUL, you actually have an asset of the entire $1 million while you're alive.
So with the, you got a question, my brother?
No.
No? Got you. So with that also, as a maximum funded policy, they allow up to 500,000 to maximize it with the TEFRA and DEFRA law. So again, it's a 5-year step at a maximum policy of $500,000 $100,000 per year, which will give you the best accumulation for yourself to become self-insured with the allowed premium. And this is just a growth account from year 1 all the way up to year 25, creating the growth process of compounding interest by maximizing your policy. It started at age 55. Same line, just as much as the growth as the starting at 25, maximizing it also. 75 a little bit lower, but again, it grows at the same rate if you have the amount of money that you can use. So think about this: life insurance policies are not investments, and accordingly should not be purchased as an investment. This is a contract for your future through the insurance company. This is what this is how our analogy looks. It's like a bucket. All right. New cash contributions and then the compound interest together allow you to have the most of the opportunity with the policy. So you put in the 500,000 as your maximum. Actually, no, take that back. You want the $1 million with the death benefit that's over there, and then the total premium that are allowed is what your policy looks like. Year 1, 2, and these each year with that $500. I'm just giving an example of a number. the 500,000 that you want to be able to put in. You got that much money to roll over. Each year, the allotted amount will be 100,000 that you can actually maximize through that time, which will give you the $1 million to get you moving to the next stage. So, and like I said, the DEFRA, you can see the years that those were coordinated, dictates the minimum death benefit required to based upon the insurer's age, gender, to accommodate the ultimate desired aggregated premium basis. Any other questions? That actually will be the end of the slideshow.
Real quick, just to point out, if you guys remember when Trump first started making headline news with his money, not paying taxes on it, was around this time frame in the early 80s. It was he was on CNN, he was everywhere, because they knew that he was gaining a lot of money, making a lot of money. But for years and years and years, it's been known that Trump just did not pay taxes on all of that. Well, Trump found out early about DEFRA, and TAMRA years ago in the early 80s. And he began to secure his wealth in vehicles like this up under those tax laws. So when he became president, of course, everybody's even mad because we want to see your tax records. We want to see your documents. Why aren't you paying taxes? Number one, legally, he does not have to show it because he's protected under these laws. He has it in IULs. He has it attached to a death benefit. Anything attached to a death benefit is not taxable. So you can have millions and millions and millions of dollars within these policies, and they're protected. And what does that mean to a business owner that's really making a lot of money? Amazon was another big one that had a lot of, made a lot of revenue, but their tax paid out in 2021 was zero. And how is that for Amazon? Is because the big corporate companies are now finding out more and more the power of the tax codes, the power of these index policies and annuities, fixed index annuities, index universal life policies, and that's where they're putting in their funds. So financially, they're protected for life because there's never going to be any losses. All the money that they're making is cash accumulating, and it's growing at a rapid rate with no loss, and they're not paying taxes on it. So it's not so much that the rich get richer and the poor get poorer, it's that the rich get wiser and do what you're supposed to do to protect, because they do follow Warren Buffett's #1 rule is don't lose money. And in taxes, that's what we're doing. We're constantly losing money because we don't know how to protect it. And our policies are called, and I tell people all the time, Nicholas hears me say it, I don't know how many times a week. You can't predict or prevent an accident or an incident from happening in your life, but you can prepare and protect. And that's what these policies actually do, is prepare and protect you for the future.
Well, sure, yeah, that's kind of it for the presentation. Any questions? I know it's kind of a quick process, but I know you guys were here, Dante, and you guys were here the last time. Any questions from the last time up till now?
What are the negatives or the cons of doing this, investing in an IUL?
The negatives.
The negatives would be people saying that you're crazy for not going with the traditional system. There really are no cons with an IUL. What's his name? Dave Ramsey hates IULs because Dave Ramsey wants you to put money over into. So he's going to find all these negative things to say. And I tell people just study and show yourself approved. We partner through Fidelity and Guarantee, AIG, American National, National Life Group. These are the primary 4 carriers that we deal with. So when people have something negative to say, because there really is no downfall, everything is protected up under the tax codes. Everything is protected up under, as a matter of fact, the company that we write our policies through, Fidelity and Guarantee actually just bought 36% of our company, looking to purchase over 60% of our company because of the power of what we're doing. So this is new for the most part when it comes to the index universal life policies. The living benefit side of this has been around since 2014. 2014 is not very long ago, right? So a lot of people aren't aware of it. So this is another reason why Nicholas and I do what we do, is we need to bring the awareness. There really is no risk and no loss. It's only protection. The companies that have been around since the early 1800s, as I was saying earlier, that's who these policies are written through. That's the arc that I was telling you guys about. So there's no downside, no cons to it.
I have a question.
Uh-huh.
So these IULs, is this something that's only meant for a business, or do you use it in your personal?
So the amazing thing is you can use it for your personal life as well. The most powerful thing you can do is get them on children when they're young, when the premiums are a lot cheaper and more affordable, because those premiums are locked in for life. But this is the power of wealth transfer, actually. So you're not only doing it as a business owner to protect your business, but you're also doing it for yourself to protect your life, because you have the rest of your life to live, right? And the you today has to take care of the you 20 years from now, 30 years from now. This is an alternative retirement plan from what the traditional retirement plan that we've always known was the answer. But this is a tax-free, protected retirement plan for you.
So I have a question.
Mm-hmm.
If we say we pull out our life insurance early, or 401k retirement, we pull out retirement early. Is that, I know it's bad because of the tax rates, because there's like a 10% plus whatever the company charges that you got.
Mm-hmm.
So, I forgot what's going on. So what do you, what I'm,
So
what do you recommend?
I can help you with that. So that's a good common question that we get. Yes. Would you rather be, again, as I said, be taxed on a higher rate when you're waiting for that retirement? Take it out now, take the hit for right now, and then place it into a better vehicle that you can still utilize the cash accumulation. You can do a lump sum and be able to create more of a financial structure for yourself, for what you may need it for, which will also give you the safety, the liquidity, and the access without being penalized on that money.
See, we're getting like the policy that my wife has right now. It's a 30% tax that the state's taking out. But is the federal, like on the federal level, or are they going to take out as well when we go and file taxes? And when we go to file our taxes, is that something that we're going to get penalized
Not
for?
as long as you put it over into another retirement alternative.
Yes.
So
Yeah.
if you were to take it out and keep it out, yes, you're going to be taxed on it because that is the 401k, right?
Mhm.
But when you roll it over into another vehicle where you can show that I have an alternative retirement plan, I did an IUL, you will not be taxed on that because now you're protected up under all the tax codes that we just shared with you.
And that takes it off of the three pieces that allow them to tax money, which is the passive income, your work income, and the retirement income. So it takes it off your 1040 and places it into, it's basically a specific vehicle that's tax free regardless of what they want to do. They still haven't changed that over the last 100 years, and I don't think they're going to change it anytime soon. That's just one thing that they can't touch because it's grandfathered in.
Yes. Yes.
So when you go to file your taxes, let's say you do have an IUL, and you, like, if you file it yourself, how do you go about putting in there? Is there like an option to say, oh, I have an IUL?
You don't
Or is it
have
just
to.
left out completely?
It's just left out
It's left
completely.
out because it's not even part of the equation. And the only time you want to use it as to your advantage is if you're going to the bank and you're looking to borrow money, or buy a new house or something, and they feel, what are your assets? Now you can voluntarily use that as an asset because it now becomes mortgage protection, right? It now becomes, your insurability, protection. So you want to use it to your advantage, but you never have to put that down because it's a tax-free. It actually doesn't even need to be, counted in with your income, so to speak, unless you're using it to your advantage.
So I wanted to get that to make sure I give you guys the right thing. 3 types of income subject to tax. That's earned income, that's salary and wages, passive income, rent and leases, and then portfolio, which would be the 401k, interest and dividends. Those are the 3 main ways that you get taxed. And with the IUL, you take that off of that your schedule 1040.
Good questions. And then the power of, as a business owner with the executive bonuses, what have you, you have your own business and you want to cover yourself in your business with an executive bonus. It's kind of just giving you a double policy, right? With the living benefits that's included with an IUL, as well, like the way the executive bonus is set up, God forbid something happens to you, you have the mortgage protection. You can use the personal policy. You can draw off the executive bonus policy. If you need your business to keep running, right? Now you can use the resources from the gains of that policy. Now you can pay someone to come in and learn to keep, what you're doing in your business to keep the production going. If you have regular customers that order from you on a regular basis, and you use the policy money to continue to pay them while you're recovering. Now, from your personal benefit side, you use those resources to pay off your mortgage, pay off your car, pay off your debt, so that you can 100% focus on recovering and getting back to health.
Now, if you aren't able to, because you're injured or something happened, and if you're not able to make the premiums.
Well, so that's also the advantage of whenever someone does a claim, those claims are typically worked within a very short amount of time, 2 to 3 weeks. Now, when you get that lump sum back from your policy, what do? You take that and you pay up your premium for a year, for 2 years, because you can make monthly payments and you can also make annual payments. So when you receive that lump sum, now I need to pay up my policy for the next 2 years so that I don't have to worry about payments and I don't have to worry about my coverage lapsing.
Okay.
Because then you won't have the money to do that. We're talking, hundreds of thousands of dollars here, so you'll be able to cover that.
So